So you spend billions of dollars gobbling up all these futuristic cyber startups to build the ultimate AI security platform. And what actually carries your quarter is the boring, supposedly obsolete hardware firewall?
It wasn't just carrying it. That was their best hardware quarter in a decade. Hyperscalers still need physical gates for those massive new data centers.
Right, the dinosaurs are back. Okay, welcome to Earnings Unscripted. It is June 2nd, 2026, and we are unpacking a really wild third quarter from Palo Alto Networks, ticker PANW. And this report is just fascinating.
Fascinating is one word for it. It looks like two completely different financial reports taped together. I mean, you look at the top line, and it is incredibly strong. Total revenue came in at exactly $3 billion, which is up almost 16% from just last quarter.
But then you look at GAAP operating income, and it is, frankly, a disaster.
A disaster is right. They swung from a healthy $397 million profit in Q2 down to $183 million loss this quarter.
And actually, before we dig into why that happened, just a quick reminder that this is just us analyzing the markets for fun, definitely not financial advice. But Miro, a 22-cent per share loss, that is a brutal swing. How much of that is just the price of buying growth?
Pretty much all of it. This is textbook M&A indigestion. They closed, well, actually, they are still actively digesting the massive CyberArk and Chronosphere deals. So you have a huge explosion in acquisition-related costs and just an absolute mountain of assumed stock-based comp. It completely warped the income statement.
Right.
But if you look under the hood at the actual operations, their next-gen security ARR hit $8.1 billion. So organic demand is absolutely accelerating.
Which they completely need to capture right now. I was reading through the call transcript, and Nikesh Arora shared this anecdote that genuinely gave me chills. They had their internal threat hunters run a simulated AI ransomware attack, and the entire thing, from initial breach to full data theft, took exactly 25 minutes.
Wow. So essentially, if a human has to sign off on a defense, you have already lost.
Exactly. You cannot have a guy sipping coffee in a security operations center trying to figure out an alert if the hackers are gone in half an hour. So Palo Alto is using this to say human-led security is dead. It is a very compelling narrative.
It is a great sales pitch, sure, but the market really did not know how to price this quarter. If you look at the immediate stock reaction, it was complete whiplash.
Oh, yeah. Didn't it totally spike right at the release?
Spiked is putting it lightly. It ripped up to nearly $339 a share in extended hours right after the print. The algorithms clearly just saw the revenue beat and bought it. But then the actual earnings call started.
And humans started doing the math.
Right. As soon as management started talking, that entire massive rally collapsed. It just kept bleeding through the whole call and eventually ended down over 4% from the prior day's close. I think investors suddenly focused on the profitability hit and the $1.3 billion in new convertible debt they just took on.
Yeah, reality always catches up when the bill for those acquisitions actually comes due. All right, let's get into the details.
And the size of that deal is staggering when you actually look at the equity they handed over.
Right.
We talked about the debt earlier, but the weighted basic share count, it leaped from around 704 million to 801 million. That is nearly 100 million newly issued shares just flooded out there to make the CyberArk peel happen.
Okay, pause. 100 million shares? That is massive dilution for a company this mature.
Yeah, and it gets complicated when you look at the operating expenses too, because with all those new employees comes unvested equity. Their stock-based compensation sequentially exploded by over $200 million. It is now sitting at 17% of total revenue.
Jeez, 17% just to pay people in stock. I mean, do they expect that to hold, or is it just a weird quarter thing?
Well, the CFO, Deepak, he promised it returns to pre-acquisition levels in 12 to 18 months. But here is the thing that really caught my eye. The transparency around whether these mega deals actually work is about to disappear.
Wait, what do you mean disappear? Are they changing the accounting?
they're changing the segment disclosures. Starting next fiscal year, so FY27, they are dropping the consolidated M&A reporting style. They are exclusively reporting on network security, Cortex, and identity.
Right, which sounds totally normal if you're pitching platformization to your customers.
Right, exactly. But what it practically does is erase Wall Street's ability to track the exact dollar accretion from CyberArk or Chronosphere. If you accidentally bought organic stagnation and you try to mask it with purchase growth, nobody can clearly parse the math anymore.
That is incredibly convenient timing. We buy these giant companies, we take a massive hit to GAAP profitability, and then we gently close the curtain on the subsegment numbers before anyone can double-check our homework.
It is classic financial remodeling. And Nikesh Arora, the CEO, was actually pretty defensive about this on the call. He literally said, the biggest fear in large acquisitions people think is that we will break it. I think the most important part is we did not break it. Look, Mommy, I didn't break it. It's working.
Look, Mommy, I didn't break it. That is such a Nikesh quote.
It is. But my question is, if you are hiding the precise metrics next year, how do we prove you did not break it?
Okay, fair point. You are definitely skeptical on the transparency there. But to be fair, they can only get away with pulling the curtain if the core business is still a rocket ship, right? And earlier you mentioned organic demand is still accelerating.
It is, and that is why they have the leverage to pull this off. If you strip out all the acquisition noise, their organic next-gen ARR still grew 28% year over year. They are actively ripping and replacing legacy competitors.
Especially in SASE, right? I saw that grew 40%.
Exactly. And on top of that, they quietly pushed through a 10% price hike on hardware starting back in April.
Oh, wow. Usually you only raise hardware prices if you're really desperate or if you have extreme pricing power.
In this case, it is power plus inflation. Memory and storage component costs are climbing. But what's wild is that even with a 10% price hike, their hardware backlog just hit record levels in Q3. So that pricing flow-through is going to seriously boost gross margins in the next couple of quarters.
Okay, so the picture is, yeah, the financial layout is a bit chaotic right now, but the actual customer demand is so inelastic, they can hike prices and still set backlog records. So where does this leave their actual trajectory heading into next quarter?
It leaves them incredibly confident. Management just raised their full fiscal year outlook across the board based on that demand. I mean, they are guiding next quarter's next-gen ARR up to almost $8.9 billion.
Almost $9 billion. That is just a staggering run rate. But stepping back a bit, I feel like the big unknown going forward is this push toward autonomous agents, letting the AI actually pull the levers.
Buyers are absolutely not ready for that. Management even admitted most customers are still sitting in what they call phase zero. They are ingesting the data, sure, but nobody actually trusts an AI agent to just shut down your global production network.
Because of the hallucination risk, right? Like, if the AI gets confused by a false positive and decides to just shut down your global production network, well, you definitely lose your job over that.
Right. The stakes are just too high right now. And that is why I actually respected Arora's tone on the call. He told analysts, quote, I wouldn't get ahead of my skis and start throwing the kitchen sink at numbers. He acknowledges that enterprise buyers still need time to mentally digest these paradigm shifts.
So basically, they are swallowing this huge, incredibly expensive financial medicine today, enduring all the Wall Street complaints about debt and dilution, all betting that when companies finally do trust AI to steer the ship, Palo Alto is the only platform left holding the keys.
It is a massive structural bet. But honestly, looking at the core organic momentum they have right now, they're probably going to pull it off.
Risky, but working. I think that is a pretty perfect summary of the company right now. All right, we will leave it there for today. Thanks for tuning in to Earnings Unscripted, and we'll catch you after the next sprint.
Talk to you then.
Just as a quick aside, if you like having these breakdowns show up in your feed automatically, Following the podcast is the best way to catch them. This show is actually generated with a little AI assistance, which is how we can magically read through massive SEC filings basically overnight, but the topics are really driven by you. So if you have a ticker you want us to cover, drop a note to earningsunscripted@datamadness.ca or check the X link to the show notes.
See you next time. And